Traditional IRA, Roth IRA, what are these things and what do they do? My name's Christian Bell, and in this video we're going to talk about traditional and Roth IRAs, what they are, why they exist, and how I approach figuring out which one I should have. Fun fact, IRA actually stands for Individual Retirement Arrangement, in the sense that it can be other things besides an account, like an annuity. So an individual retirement account is a type of IRA. But you'll see individual retirement account listed as IRAs basically everywhere. So we'll do that as well. Before we get into the benefits of IRAs, how do I actually open one? Typically you open an IRA at a financial institution like a bank or a brokerage. You get to choose what goes into your IRA. Normally we're talking about investments here, stocks, bonds, ETFs, things like that. Interestingly, certain types of derivatives trading are also possible in IRAs. But if you're just getting started, definitely learn what you're doing way before you even think about something like that. The government also wants you to save for retirement. They really want you to do this. So much so that they're even willing to lower your tax bill to get you to save. And that's where IRAs come in. Now, IRAs are a tax-advantaged personal savings plan. So you gotta pay taxes. No way around that. Now, traditional IRAs were established by the Employee Retirement Income Security Act of 1974, also called ERISA. The big tax advantage of a traditional IRA is that, in general, you might be able to deduct some or all of your contributions. This is why you'll sometimes see people talk about traditional IRA contributions being pre-tax money. If you can deduct the full amount of your contributions, then, conceptually, those contributions are pre-tax money. However, your deduction amount is affected by a whole bunch of stuff, including things like being covered by a retirement plan at work, your tax filing status, and what your income is. Another big benefit is that you don't pay tax on transactions inside the account, things like earnings and gains. But that's only while the money is still in the account. Uncle Sam still wants some taxes. So when you take money out, called distributions in IRA speak, you normally have to pay income tax on those distributions. And in general, that includes income tax on both the contributions themselves and the growth. There's also something called required minimum distributions. These are, like it says in the name, the minimum distribution that you must take. Typically, this happens to people with a traditional IRA shortly after they turn 72. Now, Roth IRAs came about later as part of the Taxpayer Relief Act of 1997, and they're named for the senator who sponsored them, William Roth. He wanted to restore traditional IRAs, which had actually been repealed earlier. But because of how congressional budget rules work, the revenue cost of giving that upfront tax deduction in the traditional IRAs was too much. So the politicians, being the clever people they are, they created this new IRA, the Roth IRA, which essentially moved the tax advantage later in the IRA's lifetime. So instead of a big tax advantage up front for people and a cost for the government up front, the tax advantage and the cost for the government happens later. And this maneuvering got around the budget rules issue. So one big advantage to a Roth IRA is that when you take money out, again, these are called distributions, those distributions are tax-free if you follow the rules. And that's both the original contributions you put in, as well as any growth on those contributions. This is a huge difference from traditional IRAs. Now, you do have to jump through some hoops to get this special tax treatment. It's called taking qualified distributions. This includes things like the money has to be in the Roth IRA for at least 5 years, and you have to be at least 59 and a half before you take it out. It's stuff like that. There are other specific situations, of course, but those are some of the most common. This difference in tax treatment is essentially tax-deferred growth, that's a traditional IRA, versus tax-free growth, that's a Roth IRA. To be clear, your money grows tax-free in both accounts while it's still inside the IRA. It's when you take distributions that the difference really shows. In general, with a tax-deferred account, your taxes on the growth are deferred. That's where the name comes from. Typically, you pay taxes on that growth when you withdraw it in the form of distributions. In general, with a tax-free account, you never pay taxes on that growth. Let that sink in for a minute. You never pay taxes on that growth. This assumes you jump through all the IRS's hoops with qualified distributions and things like that. But still, that's incredibly powerful. It means that with tax-free accounts, like a Roth IRA, you typically don't pay taxes on the exponential growth that compound interest provides. With a traditional IRA, you do. Now, another big difference is that contributions to Roth IRAs are not tax deductible. Also, there are some income thresholds for Roth IRA contributions. The max amount that you can contribute goes down to zero as you earn more money. For both traditional and Roth IRAs, there are contribution limits. For 2022, it was $6,000, $7,000 if you're age 50 or older. For 2023, it went up to $6,500, $7,500 if you're age 50 or older. Also, you can't contribute more than your taxable income. However, you can have multiple IRAs, and they can be of different kinds, but these contribution limits are in total, across all IRAs you have. Also, in general, you have until you file your taxes for a given year to make contributions for that year. If you don't follow the rules, and there are a lot of rules, you might have to pay up. Remember that the main purpose of IRAs is to help you save money for retirement. So, for example, if you take money out early, you might pay taxes and penalties that were totally unnecessary. I myself did this, and for no good reason. It's something I absolutely regret doing. Now, some economists have actually warned that Roth IRAs create a big problem for the government precisely because of how awesome they are for taxpayers. Essentially, how good of a deal it is for certain people. So for us taxpayers, does that mean that we should always choose a Roth IRA? Well, like most things in life, it depends. The tax advantages of traditional IRAs are front-loaded because you might get a tax deduction now, while for a Roth IRA, the tax advantage is back-loaded because there's no tax on the distributions later. So in general, it's really helpful to estimate when you think your tax rates will be higher. If they'll be higher in the future, paying tax now, Roth IRA, might be better. If your tax rates will be lower in the future, paying tax later might be better, traditional IRA. But there's a whole lot that goes into this estimate. Will you change careers or jobs? I did. I couldn't have predicted that 10 years ago. Will the tax rates change during your lifetime? Unfortunately, those aren't the only complicating factors. Your income also plays a big part. Maybe you're in a super high tax bracket right now, and so the tax deduction is already quite valuable to you. So you might be willing to give up the tax-free growth that a Roth IRA offers. But your age will also affect this. If you only have 5 or 10 years until retirement, the dollar amount value of that tax-free growth will be worth a whole lot less than if you're super young and you have 30 or 40 years for compound interest to do its thing. Even more issues are things like other itemized deductions you might have, as well as your state and local taxes. So yeah, it's complicated and definitely unique to your individual situation, and absolutely worth consulting with a qualified tax pro. Now, maybe you're a high roller and you simply make too much money to be able to contribute to a Roth IRA. Well, there's good news for you. Turns out, in general, you can actually contribute to a traditional IRA and then move those contributions to a Roth IRA, essentially getting around the income restrictions on Roth IRA contributions. This is sometimes called the backdoor Roth IRA. I'm not quite there yet, but it is a goal for me. There's also something to be said for diversification in tax treatment. Having multiple retirement accounts with different tax treatments can give you more options for minimizing your taxes when you retire. Personally, I think taxes are only going up, so for me, I generally prefer Roth IRAs. However, diversifying your tax exposure is an approach I've really grown to love, and it's actually how I'm personally setting up my own accounts. But what do you think? If you have an IRA, is it a traditional? Is it a Roth? Do you have both? And why? Let me know in the comments. Make sure to like and subscribe. Have a wonderful day, and I will see you next time. Bye!